Question 1. Topic. Elements of a contract. Which of the following scenarios would make an insurance contract unenforceable under the law due to the absence of a key element? A. An insurance policy where both parties agree to the terms, but one party lacks the legal capacity to enter into a contract. B. An insurance policy where the insurer provides coverage without any premium payment. C. An insurance policy that has a clear offer and acceptance but lacks consideration from one party. D. An insurance policy that is based on mutual consent but does not include a legal purpose. Answer D. Explanation. An insurance contract must meet several essential elements to be legally enforceable: offer and acceptance, consideration, legal purpose, and competent parties. Option A incorrect. Although one party lacks capacity, this would make the contract voidable and not automatically void. Legal capacity is required, but the contract can still exist. Option B incorrect. Consideration does not necessarily need to be a monetary payment. It can include promises made by both parties. Option C incorrect. Consideration must be provided by both parties. This option would generally result in a void contract, but it's not the primary issue of legal enforceability. Option D correct. Contract without legal purpose. G. An agreement to commit an illegal act is automatically void and unenforceable. A North Carolina law emphasizes that all insurance contracts must have lawful purpose to be valid. Any contract promoting illegal activity would be void from inception. Question 2. Scenario-based. Topic. Liability insurance. Jessica operates a bakery in North Carolina. She has a general liability insurance policy that covers property damage and bodily injury. One morning, a customer slips on a wet floor in her bakery and suffers a broken wrist. Jessica is concerned that her liability policy may not cover this incident. What should Jessica do to ensure this claim is valid, and what part of her policy would most likely provide coverage? A. Ensure the incident is reported to the insurer within 24 hours under the policy's reporting clause. The premises liability coverage section would provide coverage for the customer's injuries. B. File the claim immediately, but understand that bodily injury is excluded under general liability policies. C. Verify whether the customer was partially at fault, as general liability insurance only covers incidents where the policyholder is 100% responsible. D. Wait for the customer to submit a formal legal complaint before contacting her insurance company to initiate a claim. Answer. Explanation. Jessica's general liability insurance would typically include premises liability coverage, which protects business owners from claims of bodily injury or property damage that occur on their premises. Option A correct. Jessica must report the incident to her insurer promptly. The premises liability coverage section of her policy would likely cover the claim if the customer can prove negligence on Jessica's part. Option B incorrect. Bodily injury is a standard coverage in general liability policies, and this incident would be a typical claim. Option C incorrect. General liability insurance covers claims regardless of whether the policyholder is entirely at fault. North Carolina follows the contributory negligence rule, but this applies in court proceedings, not to claim coverage under insurance policies. Option D incorrect. Delaying the claim process can result in a denial due to late reporting. Jessica must notify her insurer immediately after the incident. Question 3. Topic. COBRA and HIPAA regulations. Which of the following statements about COBRA and HIPAA regulations is accurate according to North Carolina insurance laws? A. COBRA allows employees to extend health coverage indefinitely as long as they pay premiums on time. B. HIPAA guarantees health insurance coverage for individuals transitioning from one group health plan to another without exclusions for pre-existing conditions. C. COBRA applies only to companies with fewer than 20 employees, while HIPAA applies to companies of all sizes. D. HIPAA and COBRA are interchangeable terms used to describe the same law governing health insurance portability. Answer. B. Explanation. COBRA Consolidated Omnibus Budget Reconciliation Act and HIPAA Health Insurance Portability and Accountability Act are two distinct regulations affecting health insurance. Option A incorrect. COBRA coverage is not indefinite. It typically lasts 18 to 36 months depending on the qualifying event. Option B correct. HIPAA ensures portability of health coverage and limits exclusions for pre-existing conditions when transitioning between group health plans, provided there is continuous coverage. Option C incorrect. COBRA applies to employers with 20 or more employees, not fewer. HIPAA applies to all sizes of employers. Option D incorrect. COBRA and HIPAA are separate laws with different objectives. COBRA focuses on continuation of coverage, while HIPAA focuses on portability and privacy. Both laws are essential for protecting employees' access to health insurance, particularly during employment transitions. Question 4. Topic: Types of policies. Disability income insurance. Which of the following policy provisions in disability income insurance policy would most likely result in denial of benefits if the insured suffers an injury while engaging in high-risk activity not disclosed at the time of application? A. Exclusion for pre-existing conditions. B. Own occupation versus any occupation clause. C. Hazardous occupation exclusion clause. D. Elimination period provision. Answer: C. Explanation. A hazardous occupation exclusion clause is commonly included in disability income policies to exclude coverage for injuries sustained while performing high-risk activities, particularly if they were not disclosed during the application process. Option A. Incorrect. Pre-existing condition exclusions relate to prior health conditions, not hazardous activities. Option B. Incorrect. The own occupation versus any occupation clause refers to whether the policyholder is considered disabled based on their specific job or any job. Option C. Correct. The hazardous occupation exclusion specifically applies to high-risk activities or occupations that were not disclosed to the insurer. Option D. Incorrect. The elimination period is a waiting period before benefits start unrelated to exclusions for hazardous activities. Question 5. Topic: Elements of insurable risk. For a risk to be considered insurable, it must meet specific criteria. Which of the following scenarios would not qualify as an insurable risk? A. A homeowner insuring their house against fire damage. B. A driver purchasing insurance to cover potential liability in case of an accident. C. An investor purchasing insurance against stock market fluctuations. D. A small business insuring against theft of equipment. Answer: C. Explanation. For a risk to be insurable, it must meet specific criteria, including being accidental, measurable, predictable, and resulting in financial hardship if it occurs. Option A. Incorrect. Fire damage to a house is accidental and can be measured and predicted. Option B. Incorrect. Liability insurance for accidents is a standard form of insurable risk. Option C. Correct. Stock market fluctuations are speculative risks which are not insurable because they involve potential gain or loss and are not purely accidental. Option D. Incorrect. Theft is a valid insurable risk as it is accidental and measurable. Question 6. Scenario-based. Topic: Unauthorized insurers and regulatory actions. Mr. Thompson, a licensed North Carolina insurance producer, is approached by a company offering high commission rates if he sells their life insurance policies. And after doing some research, Mr. Thompson discovers that the company is not authorized to do business in North Carolina. What should Mr. Thompson do to comply with North Carolina insurance laws? A. Proceed with selling the policies as long as he discloses that the company is not authorized in North Carolina. B. Sell the policies only to clients who agree to sign a waiver acknowledging the company's unauthorized status. C. Decline to sell the policies as doing so would violate North Carolina's insurance regulations. D. Contact the North Carolina Department of Insurance to request special permission to sell the policies. Answer: C. Explanation. North Carolina law strictly prohibits insurance producers from selling policies from unauthorized insurers. Option A. Incorrect. Disclosing the company's unauthorized status does not exempt the producer from legal consequences. Option B. Incorrect. There is no waiver that can allow the sale of unauthorized insurance products. Option C. Correct. Producers must decline to sell unauthorized insurance policies to comply with North Carolina insurance laws. Engaging with an unauthorized insurer is considered an illegal act and can result in fines, license suspension, or revocation. Option D. Incorrect. The North Carolina Department of Insurance does not grant special permissions for producers to work with unauthorized insurers. Question 7. Topic: Market practices. Replacement and disclosure requirements. Which of the following is the primary purpose of the replacement regulations in North Carolina's insurance market? A. To prevent clients from switching policies unnecessarily, regardless of benefits. B. To protect consumers from making decisions based on incomplete information when replacing an existing policy. C. To ensure that insurers always issue new policies with higher premiums when replacing existing coverage. D. To guarantee that policyholders receive cash value payouts when replacing life insurance policies. Answer: B. Explanation. Replacement regulations are designed to protect consumers from potentially harmful policy replacements by ensuring they receive full disclosure about the benefits and drawbacks of switching policies. Option A. Incorrect. Replacement is not prohibited but must be conducted with proper disclosure. Option B. Correct. The goal of replacement regulations is to ensure transparency and full disclosure to help consumers make informed decisions. Option C. Incorrect. The insurer is not required to issue a policy with higher premiums when replacing coverage. Option D. Incorrect. Cash value payouts are not guaranteed during replacement unless specified in the policy terms. Question 8. Topic: Reinsurance. Which of the following best describes the primary purpose of reinsurance in the insurance industry? A. To eliminate the need for underwriting. B. To reduce the risk of catastrophic losses for insurance companies. C. To provide insurance coverage for policyholders with high-risk profiles. D. To increase premium rates for high-value policies. Answer: B. Explanation. Reinsurance is a practice where an insurer transfers part of its risk portfolio to another insurer to reduce the financial impact of large or catastrophic claims. Option A. Incorrect. Reinsurance does not eliminate the need for underwriting. It helps manage risk. Option B. Correct. The primary purpose of reinsurance is to protect insurers from catastrophic losses. Option C. Incorrect. Reinsurance is not directly related to policyholder profiles, but rather to insurers' risk management. Option D. Incorrect. Reinsurance does not increase premium rates for policyholders. Question 9. Topic: Unauthorized insurers. Which of the following actions is a violation of North Carolina's insurance regulations regarding unauthorized insurers? A. Soliciting policies from an unauthorized insurer and informing clients of the risks. B. Receiving commission from foreign insurer that is not authorized in North Carolina. C. Selling surplus lines insurance through licensed broker. D. Contacting the North Carolina Department of Insurance to verify an insurer's status. Answer: B. Explanation. It is illegal for a licensed producer in North Carolina to receive commissions from an unauthorized insurer. Option A. Incorrect. Even with disclosure, soliciting policies from unauthorized insurers is illegal. Option B. Correct. Accepting commissions from unauthorized insurers is a clear violation of North Carolina's insurance laws. Option C. Incorrect. Surplus lines insurance is legal when sold through licensed broker. Option D. Incorrect. Contacting the North Carolina Department of Insurance to verify an insurer's status is required to avoid illegal activities. Question 10. Topic: Health insurance basics. COBRA. What is the maximum duration of COBRA continuation coverage for an employee who lost their job involuntarily under North Carolina law? A. 6 months. B. 12 months. C. 18 months. D. 36 months. Answer: C. Explanation. Under COBRA, eligible employees who lose their job involuntarily can extend their group health coverage for up to 18 months. Option A. Incorrect. 6 months is not a valid COBRA duration. Option B. Incorrect. COBRA typically extends beyond 12 months. Option C. Correct. The standard COBRA continuation coverage duration is 18 months for job loss. Option D. Incorrect. 36 months applies only in certain special cases, such as death of the employee or divorce. Question 11. Topic: Property insurance. Valuation methods. Which of the following valuation methods is most likely to provide low payout to the insured in the event of property loss? A. Replacement cost. B. Actual cash value. C. Agreed value. D. Market value. Answer: B. Explanation. Actual cash value. SCV takes into account depreciation, which reduces the payout amount based on the property's age and condition. Option A. Incorrect. Replacement cost pays the full cost to replace the damaged property without factoring in depreciation. Option B. Correct. SCV results in a low payout because it deducts depreciation from the replacement cost. Option C. Incorrect. Agreed value is a predetermined amount agreed upon by the insurer and insured, often resulting in a fair payout. Option D. Incorrect. Market value reflects the current value of the property but is less commonly used in standard insurance policies. Question 12. Topic: Life insurance. Policy loans. Which of the following statements is true regarding policy loans in whole life insurance policy? A. Policy loans must be repaid within 5 years to avoid policy lapse. B. The policyholder can borrow up to the full death benefit. C. The insurer can cancel the policy if the loan is not repaid within the grace period. D. Unpaid loans reduce the policy's death benefit by the loan amount plus interest. Answer D. Explanation. When a policyholder takes out a loan against their whole life policy, the unpaid loan amount plus interest will reduce the death benefit if not repaid. Option A. Incorrect. There is no fixed repayment period for policy loans. Option B. Incorrect. Policyholders can typically borrow up to the cash value, not the full death benefit. Option C. Incorrect. Insurers cannot cancel the policy solely due to an unpaid loan unless the cash value is exhausted. Option D. Correct. The death benefit is reduced by the outstanding loan amount plus accrued interest. Question 13. Topic: Health insurance. Pre-existing conditions under the Affordable Care Act account. Which of the following is true about coverage for pre-existing conditions? A. Pre-existing condition exclusions apply for the first 12 months of coverage. B. Pre-existing condition exclusions are only allowed for individuals over age 65. C. Pre-existing condition exclusions are prohibited for all policies. D. Pre-existing conditions must be disclosed, but insurers can charge higher premiums. Answer C. Explanation. The ACAP prohibits pre-existing condition exclusions for all health insurance policies. Option A. Incorrect. Pre-existing condition exclusions are not allowed under the ACAP. Option B. Incorrect. There are no age-based exclusions for pre-existing conditions. Option C. Correct. The ACAP prohibits exclusions for pre-existing conditions in all policies. Option D. Incorrect. Insurers cannot charge higher premiums based on pre-existing conditions. Question 14. Scenario-based. Topic: Commercial property insurance. A business owner purchases a commercial property insurance policy with a coinsurance clause requiring 80% coverage. The property is valued at $500,000, but the owner insures it for only $300,000. If the owner files a claim for $100,000 in damages, how much will the insurer pay? A. $60,000. B. $75,000. C. $80,000. D. $100,000. Answer B. Explanation. The coinsurance clause requires the insured to carry at least 80% of the property's value in coverage. The insured amount is only 60% of the required amount, so penalty applies. Formula: amount of insurance carried required insurance ECLS equals out 300,000 for 100,000 x 75,000. The insurer will pay $75,000 and the business owner is responsible for the remaining $25,000. Question 15. Topic: Liability insurance. Negligence. Which of the following is an example of comparative negligence? A. Policyholder is found 100% at fault for causing an accident. B. Claimant is denied payout due to contributory negligence. C. Policyholder is found 70% at fault and the claimant is awarded damages proportionate to the policyholder's negligence. D. Policyholder is completely exonerated from liability due to assumption of risk. Answer C. Explanation. Comparative negligence assigns a percentage of fault to each party involved in an accident, and damages are awarded based on the proportion of fault. Question 16. Topic: Personal auto policy. Exclusions. Which of the following scenarios would not be covered under personal auto policy? PAP. A. The insured's car is stolen and later recovered with damage. B. The insured causes an accident while driving rental car. C. The insured causes intentional damage to their own vehicle. D. The insured's windshield is cracked due to flying rock. Answer C. Explanation. Intentional damage caused by the insured is excluded from coverage under a personal auto policy. PAP. Question 17. Topic: Business owners policy. BOP. Which of the following is typically covered under business owners policy? BOP. A. Professional liability. B. Workers' compensation. C. Business interruption. D. Employee dishonesty. Answer C. Explanation. A BOP generally includes business interruption coverage, which compensates the business for lost income during a covered event. Question 18. Topic: Workers' compensation. Which of the following best describes the purpose of workers' compensation insurance? A. To provide a retirement benefit to injured employees. B. To protect employers from lawsuits by employees. C. To cover damages to an employee's personal property. D. To offer health coverage for the employee's family members. Answer B. Explanation. Workers' compensation insurance protects employers by covering medical expenses and lost wages for injured employees and reducing the risk of lawsuits. Question 19. Topic: Inland marine insurance. Which of the following is typically covered under an inland marine insurance policy? A. Personal automobiles. B. Home appliances. C. Mobile equipment and tools. D. Real estate property. Answer: C. Explanation. Inland marine insurance covers mobile equipment, tools, and goods in transit. Question 20. Topic: North Carolina insurance regulations. Unfair trade practices. Which of the following is considered an unfair trade practice under North Carolina insurance laws? A. Offering discount for bundling auto and home policies. B. Requiring medical exam for life insurance applications. C. Misrepresenting policy terms to induce policyholder to cancel their existing coverage. D. Offering higher premiums to high-risk drivers. Answer: C. Explanation. Misrepresenting policy terms to induce cancellation or replacement is an unfair trade practice known as twisting, which is illegal in North Carolina. Question 21. Topic: Homeowners insurance. Coverage forms. Which homeowners policy form provides open peril coverage for both the dwelling and personal property? A. HO2, B. HO3, C. HO5, D. height. Correct answer: C. Explanation. The HO5 policy provides open peril coverage for both the dwelling and personal property, making it the most comprehensive form of homeowners insurance. Option A, incorrect. HO2 is a named peril policy for both the dwelling and personal property. Option B, incorrect. HO3 provides open peril coverage for the dwelling but named peril coverage for personal property. Option D, incorrect. HI is for older homes and offers limited named peril coverage. Question 22. Topic: Auto insurance. Financial responsibility requirements in North Carolina. What is the minimum required liability coverage for bodily injury per person under personal auto policy? A. $15,000. B. $25,000. C. $30,000. D. $50,000. Answer: C. Explanation. North Carolina requires minimum liability coverage of $30,000 per person for bodily injury, $60,000 per accident, and $25,000 for property damage. Question 23. Topic: Property insurance. Loss settlement options under replacement cost policy. How will partial loss be paid if the insured fails to meet the coinsurance requirement? The full replacement cost will be paid. B. The loss will be settled on an actual cash value basis. C. The insurer will pay the agreed value. D. The policy will be cancelled. Answer: B. Explanation. If the insured fails to meet the coinsurance requirement, the loss will be paid based on actual cash value (SEV) rather than replacement cost. Question 24. Scenario-based. Topic: Liability insurance. A plumber accidentally causes a flood in a customer's home while performing repairs. The customer's furniture and personal belongings are damaged. Which part of the plumber's commercial general liability (CGL) policy would respond to this claim? A. Coverage bodily injury and property damage. B. Coverage B. Personal and advertising injury. C. Coverage C. Medical payments. D. Coverage D. Products and completed operations. Answer A. Explanation. Coverage of a CGL policy covers property damage and bodily injury caused by the insured's operations or negligence. Question 25. Topic: Health insurance. Grace periods. What is the grace period for monthly premium payments under health insurance policy in North Carolina? A. 7 days. B. 10 days. C. 31 days. D. 60 days. Answer: C. Explanation. North Carolina requires a 31-day grace period for monthly premium payments on health insurance policies. Question 26. Topic: Commercial property. Business income insurance. Which of the following is not covered under business income insurance policy? The A. Lost net income during shutdown. B. Continuing operating expenses during shutdown. C. Additional advertising costs after reopening. D. Payroll expenses during shutdown. Answer: C. Explanation. Business income insurance covers lost net income, continuing expenses, and payroll costs during a covered shutdown, but it does not cover additional advertising expenses after reopening. Question 27. Topic: Workers' compensation. Employer obligations. In North Carolina, employers must provide workers' compensation coverage if they have A. 2 or more employees, B. 3 or more employees. C. 4 or more employees. D. 5 or more employees. Answer: B. Explanation. In North Carolina, workers' compensation coverage is required for employers with 3 or more employees, with few exceptions. Question 28. Topic: Unfair claims settlement practices. Which of the following is considered an unfair claims settlement practice under North Carolina insurance laws? A. Denying a claim after an investigation. B. Failing to provide a prompt claim acknowledgement. C. Offering a settlement lower than the policy limits. D. Requiring proof of loss from the insured. Answer: B. Explanation. Failing to provide a prompt acknowledgement of a claim is considered an unfair claims settlement practice. Question 29. Topic: Commercial auto insurance. Coverage symbols. Which coverage symbol in commercial auto policy provides the broadest coverage? A. Symbol 1. B. Symbol 2. C. Symbol 7. D. Symbol 9. Answer: A. Explanation. Symbol 1 provides the broadest coverage, applying to any auto including owned, non-owned and hired autos. Question 30. Topic: Surety bonds. In a surety bond, who is the party that guarantees the performance of the principal? A. Obligee. B. Guarantor. C. Surety. D. Insurer. Answer: C. Explanation. The surety is the party that guarantees the performance of the principal to the obligee. If the principal fails to perform, the surety compensates the obligee.